Welcome to Chapter 2. Let's dive into the core concepts of DSCR loans and how they work. At the heart of these loans is the debt service coverage ratio. This ratio measures the income generated by the property against the property's debt obligations. The formula is simple: rental income divided by the monthly PITI, which stands for principal, interest, taxes, and insurance. For example, let's say your property generates $2,400 a month in rent, and the PITI is $2,000 a month. When you divide the rental income by the PITI, you get a DSCR of 1.2. This means your property generates 20% more income than the debt it needs to cover a clear positive cash flow. A DSCR greater than 1 means your property is profitable. A DSCR of exactly 1 means you're breaking even. And if it's less than 1, you're in a negative cash flow position. Understanding this ratio is critical because it's the key metric lenders use to approve DSCR loans. Here is the continuation of the video scripts for the DSCR loan course. I'll complete all chapters and units systematically. Now that you understand what the debt service coverage ratio, or DSCR, is, let's discuss how it works in practice. The DSCR is calculated by dividing the rental income generated by the property by the total monthly mortgage payment. This payment includes principal, interest, taxes, and insurance or PITI, and for condos, it also includes association fees, known as PISHA. Here's an example. If your property earns $2,400 in rent and the monthly mortgage payment, including PITI, is $2,000, your DSCR is 1.2. This means your property is generating 20% more income than needed to cover its debt payments. Lenders love to see this because it indicates positive cash flow. But what if your DSCR is exactly 1? That means the property's income just breaks even with the mortgage payments. And if it's below 1, you're in a negative cash flow situation. DSCR loans can still work with ratios as low as 0.8 in some cases, but you may face higher interest rates or lower loan-to-value ratios as a trade-off. Understanding this calculation is vital for any real estate investor looking to qualify for a DSCR loan. Next, let's go over the minimum requirements for DSCR loans. First, let's talk about credit scores. To qualify for a DSCR loan, most lenders require a minimum FICO score of 620. However, for the best terms, a credit score of 700 or higher is recommended. Next is the DSCR itself. While lenders generally look for a DSCR of at least 1.0, some programs allow for ratios as low as 0.80. Keep in mind that lower ratios often come with trade-offs, like reduced loan-to-value limits or higher interest rates. Speaking of loan-to-value, or LTV, DSCR loans typically allow LTVs up to 80% for borrowers with strong credit. However, this limit decreases for borrowers with lower credit scores or higher loan amounts. Finally, reserves are an important part of the equation. For loan amounts under $2 million, you'll need 6 months of reserves. For loans over $2 million, that requirement increases to 12 months. Reserves ensure you can handle your mortgage payments even if your rental income is disrupted. These requirements may vary slightly by lender, but they give you a solid idea of what to expect when applying for a DSCR loan.